This is lecture 3, which is the second lecture on financial statements and transaction analysis. Last time, we learned about debits and credits and how they impact the account categories. So we have assets, liabilities, equity, revenue, and expenses. And you'll notice I made a slight change here. For expenses, I changed it to expenses and dividends. Now, dividends and expenses are not the same thing. Dividends are not on the income statement. They're not part of calculating profit or net income. But for the purposes of debit and credit, they behave like expenses. So I'm just putting them there with that last category. So remember, assets increase with a debit. And if you think about the hand rule, right, the pinky and the thumb touching, right, that indicates the outside ones. The assets and the expenses are the ones that increase with debit. And then the three middle ones, liabilities, equity, revenues, they increase with credit. Okay, so what we're going to do today is we're going to practice some more transactions. But just before I get there, I do want to take a little step backward and ask, what is a transaction? Right? Last time I said it was a financial event that impacts the company, but what does a transaction really have to have in order to qualify? So it turns out a transaction has to have certain characteristics. So first, a transaction must have an impact on the company. Right? If it's not impacting the company is not going to record it. Okay? Next, the transaction must be reliable. Okay? So we have to be certain that the transaction took place and that it's actually impacting in the way that we thought. Okay? Third, we have to be able to measure the impact of the transaction. Right? So we need to be able to have a number to go with it. It's hard to have a journal entry without a number. And then lastly, the transaction has to have a current impact on the company. So in other words, it has to impact the company right now. If the transaction only impacts the company in the future, then we don't record it now. What we do is we wait until that future time and we record it at the time it impacts the company. Right? So it's okay if some of the pieces of the transaction are for the future, but we need something impacting the company today, right now, in order to record that transaction. All right, now I know this all seems really theoretical, so let's think about some examples, right? And talk about whether or not those are transactions. All right, so for our example 1 today, we're going to determine whether or not each of the situations is a transaction for the company. All right, so let's take a look here at the first one. Republicans present a corporate tax cut bill in the House. This bill would cut income taxes for every corporation. Democrats vow to vote against the bill. Okay, so let's say that I have a company and my company pays income taxes. Is this a transaction for my company? All right, so you may have an instinct, right? Is it a transaction or not? But let's go through the criteria. First, does it impact my company? All right, well, if I pay income taxes and it's going to cut income taxes for every corporation, then it's definitely going to impact me. So it does impact my company. All right, next, is it reliable? All right, this is probably the biggest problem with this situation, right? They're presenting a bill, and a bill is not law. It has to pass through a number of steps before it becomes the law. On top of that, there's obvious opposition to this bill. So it's far from certain that this bill will pass. So therefore, it is not reliable. So that prevents it from being a transaction. Now, is there anything else that prevents it from being a transaction? Let's keep going. All right, so the third one is that we have to be able to measure the impact of a transaction. All right, so let's say this bill did pass, right? Let's say it was now law. When does it go into effect? right? It's probably not going to go into effect for 2020, even if it passed right now. Generally speaking, when tax bills are passed, when most bills are passed into law, they go into effect at some future date. So for a tax bill, it would probably be effective as of January 1st next year. So do I know what my net income is going to be next year? No. Therefore, it's really tough to be able to measure the impact of this. Even if we were certain it was going to happen, it's difficult to measure right now. And that also ties into the last issue. Is it impacting the company right now? Well, no, not if the bill does not go into effect until the future, right? So then we would wait, even if it did become law, we'd wait until next year after we earned income to determine the amount of the impact and record it. So this is definitely not a transaction. All right, let's take a look then at B. A company mails its tax return to the IRS. This year's tax rate is lower than last year's tax rate. All right, so is this a transaction? Whatever your gut instinct, hopefully you can agree that B is a lot closer to being a transaction than A. So let's talk about the specifics. All right, first, does this impact the company? Yes, it's the company's tax return, right? All right, is it reliable? All right, if I'm filling out tax forms and calculating numbers and mailing the return to the IRS, that's pretty reliable, right? I'm not going to quibble about that. Okay, thirdly, can we measure it? Well, there are numbers on the tax return, right? We calculated the tax that we owed. So therefore, it is measurable. We have amounts. Does it impact the company today? Does it have a current impact? Well, let's see. If we owe taxes, we're including a payment right now, right? So that's impacting the company today. And if we're getting a refund, then we can expect the refund at any time. And we're going to have some kind of receivable to record that. So yes, it is impacting the company right now. So B is a transaction. Okay? So the point is to illustrate the vast gulf between A, which is not a transaction, and B, which is. All right, let's try another type of example. You know, every year, right, twice a year, I have to renew my auto insurance. And right before that happens, I get all kinds of junk mail and spam and everything where the insurance companies try to contact me to get me to switch to them. So whenever my auto insurance renews, I'm getting this kind of spam. Now, for some reason, the worst offender is Geico. I'm always getting stuff from Geico, and they really, really want me, apparently. So let's say that I give in. I'm like, all right, I keep getting all this stuff from Geico. Let's give them a call and see if I can save some money. So I call up Geico and the lizard answers, right? You know, the lizard on all their advertising. And it has a British accent. So, you know, I'm immediately listening and I say, hey, you know, tell me about your car insurance. All right, so let's think about a situation like that. And I'll formalize it a bit. So for the question, customer calls up a company and states that they are interested in hearing about the company's services. Okay? So I call up Geico and I say, hey, I'm interested in hearing about your car insurance. Is this a transaction for the company? All right, so does it impact the company? Well, I'm calling the company, I'm asking about work that they do, so it does impact them. Is it reliable? Well, that's where things start to fall apart, right? Is there a guarantee that I'm doing anything? I mean, I am an accountant, so I have no social life. Maybe I get my fun on Friday nights by calling up salespeople and having them do their spiel and leading them on, and then saying, oh no, I'm not interested, and hanging up, right? Maybe that's how I get my jollies. Regardless, just because I call up and I'm asking for information, that does not mean that this is going to take place. So it's not going to be happening if I'm not committing to anything, and I'm not here. All right, outside of that, can we measure the transaction? I mean, they can give me a quote, I can give them information, but that quote is not confirmed until they confirm what I'm telling them. You know, I could say, oh, I've never had an accident, and maybe I've had 5 accidents in the last year, right? Who knows? They have to verify all my information before the quote is certain. So we do have numbers, but they're not certain numbers. So I would argue it's not yet measurable. And of course, lastly, does it have a current impact on the company? Well, let's say that I was getting insured. When would that insurance begin? Is it going to begin yesterday? No, right? I'm not going to get insured for yesterday. In fact, legally, I can't actually get insured for any time earlier than midnight tomorrow morning, right? So you can't get insured for the same day that you're getting the insurance. I guess that's so I can't get an accident and then go get insurance and then claim the accident happened after I got the insurance. Whatever the case, the earliest I could possibly get insured would be tomorrow. So it's not impacting the company right now. Okay, let's move along on this. Let's say I'm listening to that lizard. I love the British accent. It lures me in, and I say, oh, I'm going to do it. And I run right down to my local Geico office, and they give me a contract, and I sign a contract. All right. Now, I haven't given them any money, but I have signed a contract. So let's formalize that in the question. So the customer in C signs a contract with the company, agreeing to have the company provide services for the next 6 months, starting the next day. So it's starting tomorrow. No money is exchanged. All right, is this a transaction? All right, again, even if it's not, and we're not sure yet, it's a lot closer than what we had in C. So let's go through. All right, does it impact the company? Yes, definitely, right? The company's involved, it's their contract. Is it reliable? Yes, I signed a contract. That's very reliable, right? It's committed. Is it measurable, right? Well, yes, right? Presumably, there are numbers in that contract, how much I have to pay and what they'll pay if I have an accident, right? So there are numbers in there, it's measurable. But then we get to that last piece. Does it have a current impact on the company? Oh, when does the insurance period start? The next day, tomorrow. It's so close, but not quite. Starting tomorrow, we're going to have a transaction, right? When the company actually starts doing something for the customer, when they start actually insuring me. But right now, the company hasn't done anything. I haven't given them any money. They haven't done any work for me. The transaction's not impacting the company right now. So this is on the edge, but it's not quite a transaction. It's really close, but not there. All right, now let's clinch it. Let's say that in addition to signing the contract, I give them a payment for the first month of insurance in advance. All right, so in E, the customer in C and D pays the company in advance for the services to be provided over the next 6 months, starting the next day. All right, so in this question, the customer signed the contract and they paid for the first 6 months in advance. All right, we already know it impacts the company, it's reliable, it's measurable, and now the customer is giving the company cash today. So even though the insurance period doesn't start until tomorrow, that's in the future, the cash payment is today. And that is a current impact on the company. So that would make this a transaction to be recorded. And in a couple of lectures, we're actually going to talk about this exact transaction. You know, what does the company do when customers pay for stuff in advance? And we'll go through that. For now, we'll just say that because there's cash exchange today, it impacts the company right now. And so therefore, this is a transaction. All right, let's do one more example. All right, so in this example, Mark Zuckerberg, who is the primary founder and the owner of Facebook, funds a charitable organization with his own money. Okay? So if you know Mark Zuckerberg, he does fund a number of charitable organizations. So let's say that he decides he wants to fund computer labs for students in East Palo Alto. All right, so he takes his money, he founds that transaction. He founds that charity, I should say. Is it a transaction for Facebook? All right, well, it's clearly reliable, right? Because he's funding the charity right now. It's measurable because we have an amount of money he's putting in the charity, right? It's impacting right now because he's paying the money right now. But the problem is, it's not a transaction for the company. This is a personal transaction for Mark Zuckerberg and has nothing to do with Facebook itself. Just because Mark owns Facebook doesn't mean that everything he does relates to Facebook. So this would be a personal transaction for Mark Zuckerberg, but not a transaction for Facebook because it does not impact the company. Okay, so hopefully this gives you an idea of the kinds of things that we would record as transactions, that we'd record in journal entries. So what I'd like to do now is go through some of the stuff we were talking about last class, right? Let's go through some examples of these transactions and how we would record them as journal entries. Okay, so example 2. Paul Sanders opened a haircutting salon on May 1st. During the month of May, Paul had the following transactions. Okay, A, Paul invested $8,000 of his personal funds in the business. The business issued common stock to Paul. Okay, so what's involved in this? Now remember, there always have to be at least 2 things, but it's okay to identify them one at a time. All right, so Paul is investing his funds in the business. That would be cash, right? So Paul is giving cash to the business. So for the business, because remember, we're doing all of this from the company's point of view. So for the company, what's happening with cash? So let's go back to our diagram here. In fact, I think I'm going to just copy this down because we're going to be looking at it a lot. Okay, so cash is an asset. So for the company, is cash increasing or decreasing? Well, Paul is giving his money to the company. So for the company, cash is increasing, and that's going to be a debit. So we are going to debit cash for $8,000. Now, what else is involved? Well, the business issued common stock to Paul. All right, now common stock, that is part of equity, right? Now the company had nothing. Remember, all companies start with 0 in everything. So the company had no stock, and now they've created stock. So now they have stock when they didn't before, right? So that is an increase to common stock. We are going to credit common stock. Even though the stock is being given to the owner, that's the purpose of stock, right? Stock is supposed to be given to the owners. So we're going to increase the common stock because the company didn't have stock and now they do. All right, let's try another one. The salon purchased furniture. $2,000 was paid in cash and $3,000 was paid on account. All right, so the salon is the business, right? It's a haircutting salon. So the business bought furniture. They paid $2,000 in cash. right? Give you a hint, cash is usually the easiest thing to figure out. So often it might be the first part of your journal entry that you do. All right, so let's think about it. $2,000 was paid in cash. We know that cash is an asset, right? And if they're paying cash, then cash is going to be decreasing. So we're going to have a credit to cash, right? So what we're going to do here is we're going to have a debit line, right? We're going to leave something there because we know there will be a debit. We just don't have it yet. And we are going to credit cash, $2,000. All right, now $3,000 was paid on account. All right, what does that mean? Well, account probably means accounts payable or accounts receivable. It means that they didn't pay cash right away. All right, now in this case, we're talking about a payment. This is going to be debt for the company because the company will have to pay this money later. So that means it's going to be accounts payable, right? When the payment happens, it's the company that will be paying the money and the cash will be leaving. So we're talking about debt, a liability, which is accounts payable. So does the company have more debt or less debt? Well, the company is taking on more debt. So we have another credit. We're going to credit accounts payable for $3,000. All right, we're still missing something. Well, what did they purchase? Well, they purchased furniture. All right, furniture is another type of asset. For the company, furniture is increasing because we are buying it. So we are going to debit furniture. Now, what amount are we going to debit furniture? Well, when we record an asset, we have to record it at its full cost. Now, the cost of the furniture is going to be the $2,000 of cash and the $3,000 of debt added together. So the full cost of the furniture is going to be $5,000. All right, so there is our journal entry. All right, let's look at another transaction. Let's say Paul purchased furniture for the business. Paul purchased furniture for use in his home, costing $1,500 on account. All right, so the furniture is for use in his home. Is this a transaction? Not for the company. This is a personal transaction for Paul. Doesn't matter how he paid, he's paying with his own money and the furniture's for use in his own home. So this is not a transaction for the business. All right, let's try another one. D. Supplies costing $850 cash were purchased by the salon. All right, so this is impacting the business because the salon is the business, that's the company. So they purchased supplies costing $850 cash. All right, now supplies, that's an asset. So we have an asset and they're buying supplies, so supplies are increasing. That's going to be a debit. And of course, they're paying cash. Cash is also an asset. And since they're paying, cash is decreasing. So that will be a credit for cash. Okay, let's keep going. That should be. All right. The salon performed haircutting services for customers totaling $1,400. These customers paid in cash. All right, so let's do the easy part first, which is the cash, right? So cash we know is an asset. The customers are paying, but they're paying us, right? So we're actually collecting the cash. So cash is increasing, and that's a debit for the company. The customers are paying us. All right, now what's the other side? Well, the other side is here. The salon performed haircutting services for customers. Now, we talked last lecture, what does it mean when we say that the company is performing services or doing work for a customer? Well, whenever the company does something for a customer, they're doing it because that entitles them to payment. So doing anything for a customer is earning revenue. So if we're performing services for a customer, if we're doing work for a customer, if we're giving goods to a customer, all of that stuff is revenue because we are doing something for the customer that will now require them to pay us. So we're going to have service revenue. All right, so clearly that's revenue. So does the company have more revenue or less? Well, we are now earning money. We're earning revenue. So revenue is actually increasing. So that will be our credit. Okay. All right, now let's try a similar transaction here with F. The salon also performed haircutting services for customers totaling $2,600. These customers paid on account. All right, so this is the same thing as what happened in E, except for how the customers paid. So in E, they paid in cash, but in F, they paid on account. That means the customers did not pay cash at the time the services were done. Instead, they said, hey, we're going to pay you later. And the company agreed. All right, so what do we call that when customers owe us money because they haven't paid yet? All right, that is what we call an account receivable. Right? We know it's receivable because in the future when the customers pay, we'll be receiving that money. All right, so the accounts receivable, that's an asset because we're going to collect cash in the future. So do we have more customers who owe us money or fewer customers who owe us money? All right, we've got more customers who owe us money, so we have a debit to accounts receivable. All right, now the rest of this transaction, the service revenue is exactly the same because the same thing is happening in E and F. They're performing services for customers. So we're still going to see an increase or a credit to service revenue. Right? So let's repeat. The service revenue is credited because we did work for customers. We performed services. However, the payment method was different in E and F. In E, they paid cash, so the company had an increase in cash. In F, the customers paid on account, so that meant that the company recorded accounts receivable. All right, so let's move from revenues to costs. Let's take a look at G. At the end of the month, the salon paid advertising costs for the month of May of $900. Okay, so we're talking about the month of May, right? Paul opened his hair salon on May 1st, right? And Paul had transactions during the month of May. So at the end of May, at the end of the month, they paid advertising costs for May. All right, so advertising costs. Have we used that advertising? Well, the advertising was for May and it's now the end of the month. So it sounds to me like we've used it, right? When we've used something up, we call that an expense. So what we have here is advertising expense. All right, so let's go look at our table here. right? Expenses, right, are going to be here. Do we have more expense or less expense? Well, we didn't have an expense before, and we do have an expense now, so we've increased our expenses. We have a debit to advertising expense. All right, now, what about the other side? It says they paid the advertising costs. All right, so what does paid mean? Okay. Well, if it just says paid with no other details, we assume that means they paid in cash, right? So if you pay for something, the assumption is you paid with cash. So if they paid with cash, we know cash is an asset. So we have an asset and we're paying, so cash is decreasing. That is going to be a credit. So we're going to credit cash for $900. Okay, let me just take a step aside for a moment. I often have students who come to me and they say, hey, we're confused with this revenues and expenses stuff. We're not quite sure if it should be increasing or decreasing. All right, I'm going to give you an easy answer to that. Revenues and expenses and dividends, they are always increasing. That's not entirely true. There's actually one time in the whole year where they decrease. We're going to talk about that in a couple lectures. But generally speaking, revenues, expenses, dividends, they are increasing. Okay, so why is that? Remember last time I said that the income statement was like a video, right? Where we took a video of the party and then afterward you could watch it and collect information. So let's pretend you're watching that video of the party, and every time somebody enters the party, a brand new person enters the party, you're going to make a tick mark, right? You're counting the number of people who came to your party. Now, I'm making marks. I'm counting the number of people who came to the party. Is that number ever going to go down? Right? I mean, maybe if I made a mistake and I counted too many people, I might get rid of one. But no, generally that number is just going to keep going up. The first person who comes is the first person I count, and then as more people come, I'm going to count and go up. Same thing if I think about, well, how many hamburgers were eaten, right? Every time a hamburger gets eaten, I'm going to count it down. And so that number is never going to decrease. It's just going to keep increasing. That's how revenues and expenses, and also dividends, that's how they all work in accounting. We start at the beginning of the year with that blank piece of paper with zero, no revenues, no expenses, no dividends. And then as they happen during the year, we record them. We put them in a journal entry. We count them. And that number is always going up. We always have more revenues. We always have more expenses, more dividends. Okay? So if you're confused, hey, I have a revenue, I have expenses, I have dividends, is it increasing or decreasing? The answer is always going to be it's increasing. Okay, so that's the quick and dirty answer. And the reason for that is because we are just counting them as they pile up through the year. Okay, let's move on to H. All right, so for H, salon employees were paid $2,500 for the month of May. Okay, well, let's get the easy part. They paid $2,500. Remember, with no other details, payment means cash. Now, cash is an asset and we're paying, so cash will be credited, decreased. So let's put that in there. We know there's going to be a debit space, but we're going to credit cash. All right, so what's going to get debited? All right, what were they paying for? They were paying for their employees, right? So that means they're paying salaries. Now, have we used up the benefit of those salaries? Well, we talked about this last time, right? Generally, employees are paid after they do the work. So they've already worked for us. We've already received the benefit of their work. That means we've used it already and we have an expense. So here we have an expense, salary expense, and like expenses do, it is increasing. We have more salary expense. So our debit is going to be salary expense. All right. Okay, let's move to our next one. For I, the salon received a utility bill for $350. As of May 31st, it had not been paid. Okay, so there's no cash here, so nothing super obvious in the front, but let's look at this. They received a utility bill. Now, we mentioned utilities last time. Utilities are things that, connect to a building or help the building operate. So utilities are things like electricity, water, gas, internet, garbage, right? These are all utilities. So how do utilities bill? Well, generally speaking, with things like electricity or phone, right, or even garbage, we use the utility first and then we get a bill, because often that bill is based on usage, right? They can't even send a bill till they know how much we've used. So the utility bills generally are paid after we have used the utility. So the fact that we're receiving a bill is an indication that we've already used the utilities. Now, if we've used the utilities, right, that means we've used something up, so we have an expense, and expenses are always increasing. So we're going to debit utilities expense. All right, so we're going to have a debit to utilities expense. All right, now, the bill has not been paid. All right, so what does that mean? It means cash is not involved, but we do have that bill to be paid, and we have an account for that. We call that accounts payable, right? We know it's payable because when this payment is finally made, that cash is going to be leaving the company. We're going to be paying it. All right, so we have a bill that hasn't been paid. That's accounts payable, and that is debt. That is a liability. So do we have more debt or less debt? It's pretty clear we have more debt. So our credit is going to be accounts payable. All right, moving along. So we've got 3 more here. Let's look at J. So the salon paid Paul $100 of cash dividends. All right, so cash, that's pretty obvious. So let's go look at cash. We know cash is an asset, and if the salon is paying, right, even though they're paying to Paul, the owner, the business is paying, so the business is losing cash. Cash is decreasing. That will be a credit. Now, the other thing involved was dividends. That's what the salon is paying. And dividends, right, they're their own category, and they are increasing. The company had no dividends, and now they do. So that will be the debit. So we're going to have a debit to dividends and a credit or a decrease to cash. So let's write that down. A debit to dividends and a credit to cash. There we go. All right, next one, K. The salon collected $225 of accounts receivable. All right, So we're collecting accounts receivable. What that means is the accounts receivable, remember back up here when we did work for the customers and they didn't pay us, right? We set up accounts receivable. That was to record the customers who owed us. Now, some of those customers are now paying. We're collecting some of this money. So some of the customers are paying off their accounts receivable. So what does that mean for accounts receivable? What's happening to it? Well, if we're collecting this money that we set up here, then the accounts receivable should go down. Let's look at it on the debit credit table. Accounts receivable is an asset, right? And it represents customers who owe us money. So do we have more customers who owe us money or fewer customers who owe us money? Well, since these people are now paying us, we now have fewer people who owe us money. So that's a credit, a decrease to accounts receivable, right? But it makes sense because we debited when those accounts receivable were created, when we did the work and they didn't pay. And now that they're paying us, we're going to credit accounts receivable, right? So let's put that in. Okay. Now, when the customers pay, what are they paying with? Well, they're going to pay with cash, right? That's the only thing we accept as payment. So we're collecting cash, right? It doesn't say we collected cash, but when you're collecting payments from customers, the natural assumption is that's a cash payment. So cash is an asset and cash is increasing for the company. So that's going to be our debit. So we're going to debit cash. All right, one more transaction, L. All right, $1,100 was paid on the accounts payable to the furniture store. Okay, now this happened a while ago, all the way back in transaction B. Remember here, we bought furniture, and when we bought furniture, we didn't pay for it all right away. Some of it was paid on account. So we set up accounts payable. All right, so let's go back to this other question down here. $1,100 was paid on the accounts payable to the furniture store. All right, so what's happening to the accounts payable? Accounts payable is a liability, right? Money we have to pay, it's debt. So what's happening? Do we have more debt or less debt? Well, if we're paying it off, we have less debt. So that means we're going to debit accounts payable. All right. Now, we are debiting or decreasing accounts payable, but what's the other thing that's going on? Well, it says it was paid on the accounts payable. We're obviously going to be paying off that debt with cash. So our cash is an asset, right? And we are paying, so cash is decreasing. So cash is going to be our credit. All right, so looks like I messed up something there. Yeah. Technology, you gotta love it. Okay, so here with L, we are now crediting cash for $1,100, right? Because cash is decreasing. So when we bought the furniture, we set up accounts payable, we increased a liability, that was a credit. And now that we're paying the accounts payable, we're decreasing the accounts payable, we're debiting it, and we are also now paying the cash. So cash is the credit. All right, so there's a good sampling of transactions to show you the different kinds of things a company does. And for the most part, these are the kinds of transactions that a company will have every single day, right? They'll be buying things, they'll be paying bills, they'll be doing work for customers, they'll be receiving money from customers, paying off bills, all kinds of things like this. So these are the kinds of things you'll see a company doing every single day. Now, what I would like to do is I'd like to take all these transactions and create financial statements for Paul's Salon. Now, if you looked at the homework questions that I assigned last class, one of the questions was there was a company and the accounts got all mixed up and you had to create the financial statements. Right? So the point of that is understanding which accounts go on which statements and how they're all laid out. So let's talk about that right now. Right? Let's do it for Paul's Salon. Now, Paul's Salon only started on May 1st. And remember, when a business starts, it has nothing. So there was nothing before any of these transactions occurred. So we're going to create those financial statements. Now, if you looked at that homework question, there was a hint there that said that you should prepare the financial statements in a certain order. Now, I'm going to follow that order right here. And as I do, hopefully you'll see why that order is helpful. So we're going to start with the income statement. Now, every financial statement needs a title, right? So we start with the title with the name of the business. And this is Paul's Salon. So we're going to start with Paul's Salon, then the name of the statement, which is the income statement. And then remember, the income statement is over a period of time. It's not a point in time, it's the video, right? It's a period of time. So we want to make it clear it's for the whole period. So it's for a month. It's not just a day, it's the whole month. But we have to, of course, specify which month. So that's where this part, the ended May 31st, comes from. So it's for the whole month ended May 31st. All right, so there's our title. Now let's prepare the income statement. The income statement we learned last time is revenues minus expenses. So we're going to start with our revenues. Now with this company, we have one kind of revenue. We have service revenue. Okay. Now, how much service revenue do we have? Well, let's see. We go back and look at our transactions. Oh, we had service revenue right here for $1,400 in E. But we also had service revenue in F for $2,600. So our total service revenue is going to be these two amounts added together, $1,400 plus $2,600. So that's going to give us total service revenue of $4,000. All right, now you'll notice here I put the calculation. That's so if you're looking at the notes later, you know where the 4,000 came from. But on a real income statement, we just leave the $4,000. You wouldn't have to put where that number came from. All right, so we have service revenue. Now that we have our revenues, we have to subtract our expenses. So what expenses did this company have? Let's see, if we go back and we look at the transactions, right? Our first expense here is in G. We had advertising expense of $900. All right, so let's put that in. Advertising expense of $900. And notice I'm using the brackets to signify that it's subtracted. If you would prefer to use a minus sign, that's okay. I just want you to get used to seeing the sign. There we go. All right, so we're subtracting advertising expense. Now there are some other expenses too. Looks like we have salary expense of $2,500. So we're going to subtract that. Put that in there. And then there was one more expense, utilities expense. Looks like we have utilities expense of $350. So we'll put that in as well. All right, so our expenses here, let me neaten this up a bit. We're going to have advertising expense and salary expense and utilities expense. All right, now we have revenues, we subtract expenses, that's going to give us net income. So we're going to have one final line, net income, which works out to $250. All right, so that's how you prepare your income statement. Just revenues minus expenses is net income. Even gonna. Okay. Now, our next statement that we're going to prepare is the statement of retained earnings. So, like the income statement, like all financial statements, it needs a title. So we have Paul Salon, we have a statement of retained earnings, that's the name of the statement. And again, the statement of retained earnings is over a period of time. So we have to say that it's for the month and then specify which month. The month ended May 31st. Now, last time we learned the formula for the statement of retained earnings. We learned that it starts with beginning retained earnings. Now, the beginning in this case is going to be the start of the business, May 1. And we said at the start of the business, it has nothing. So the beginning retained earnings, because it's the start of the company, they're going to be 0. Okay? All right, now then what we're going to do is we're going to add net income and subtract dividends. So let's put those in there. Net income is $250. Where did I get that? I got it here from the income statement, right? This is why the income statement should be done first. Because if you tried to do the statement of retained earnings first, you'd get to net income and you'd say, hey, I don't know what it is. Then you'd have to go back and do the income statement anyway. So we typically do the income statement first because we know we're going to need this amount for the statement of retained earnings. Okay. As for the dividends, well, that was in Part J, right? We know that there were $100 of dividends. All right, and then once all that's done, we add everything up and we can get our retained earnings at the end of the month on May 31st, which is $150. Okay. For some reason, my font didn't copy over, so let's just make that work. All right. And it still doesn't like it. Oh, well, we'll leave it there. Okay, so that's our retained earnings. All right, the last thing we have is we're going to have a balance sheet. And I think this one might take a little bit more room, so I'm going to put that in a new page. All right, so let's prepare our balance sheet. Now, like the other two financial statements, we need a title, right? It's Paul Salon, it's a balance sheet, but the balance sheet is at a point in time, right? So we're just recording it at that one moment. So we don't need to say for the month or for the year if it were a year. It's not for a month or a year, it's at one moment. So all we say is May 31st. Now, technically, May 31st is an entire day, right? And yep, an entire day, you know, that makes it look like that's the whole thing. But by convention, we know that the balance sheet is at a single moment. So when we say May 31st, we don't mean the whole day. We actually mean the very last moment of May 31st. So 11:59 p.m. and 59.9999999 seconds, right? That moment. So we mean the end of the day at May 31st. So after May 31st is essentially over, at the end of that day, before June 1st begins, that is the moment we're taking our picture. All right, now, what goes on the balance sheet? Assets, liabilities, and equity. All right, so we're going to start here with assets. Okay, so what assets does the company have? Well, got to go back and look. What assets does the company have? Well, the first obvious one, the one that we see everywhere, is cash. So we're going to list cash. But how much cash does the company have? That's tougher to figure out. Cash is everywhere. We're going to have to add it together. So, all right, let's figure this out. Okay, so for cash, we started out with $8,000, right? So we've got $8,000 of cash. And then let's see, transaction B, we spent $2,000 of cash. So we're going to subtract $2,000. All right, and let's keep going. C wasn't there. In D, we spent $850 of cash. So we're going to decrease cash by $850. And then let's see, in E, we earned cash. So cash increased by $1,400 when customers paid us. So we're going to add that $1,400. All right, let's keep going. So in F, no cash. In G, we paid $900 of cash for advertising. So we'll decrease by $900. All right, and let's see, in H, we spent $2,500 on salaries. So we have to subtract $2,500. All right, in I, no cash. In J, we paid $100 for dividends. So we're going to decrease cash by $100. In K, we collected $250 of cash. Customers paid us, so cash increased by $225. That will be added. Oops, that's up here. And let's see, then lastly here in L, they paid $1,100 to the furniture store. So we decrease by $1,100. Okay. So adding all that up, that equals $2,175. All right, was that fun? Not really. I'm scrolling up and down. I'm jumping back and forth with the journal entries. I have a big calculation here. Digging out all these numbers was not easy. And you can imagine for a real company, which has a lot more transactions than this, it would be nightmarish. The good news is that is the only time we're going to do that. This is temporary. On the next lecture, I'm going to talk to you about the T accounts that I mentioned last time. And I'm going to show you how we use the T accounts to accumulate all of this information to put it in one place. So that makes it easier to find, and therefore it's easier to calculate and get this number at the end. So it's not always going to be this annoying. This is just for this one question. So just trust that next lecture we'll learn how to make this thing a little bit easier. You'll still have to do the math, but you won't have to go digging around for the numbers. In any case, we know that cash is $2,175. All right, so there's our cash. All right, now what other assets do we have? Well, let's see. If we go down the list, furniture. Furniture is an asset. We have $5,000 of furniture. So let's put that here on our balance sheet. All right, so we have $5,000 of furniture. Now we have some other assets too. We have two other ones. Let's see here. Supplies. Supplies is an asset, and we have $850 of supplies. So we're going to add supplies of $850. to our balance sheet. Okay, oops. All right, and then there's one more. We have, oh, where is it? We have accounts receivable. That's an asset too. But accounts receivable, we had a couple of things happen, right? We had $2,600 of accounts receivable here, but then remember, down here in K, $225 of that was paid off. So the accounts receivable that we have is going to be the $2,600 minus $225. So we're going to have, and that's going to give us $2,375 of accounts receivable. So let's put that here on our balance sheet. All right. And for some reason I have weird spaces, so let's just recopy the whole thing. All right, so there are our assets. Once we have them all, we can add them all up to get total assets of $10,400. Okay, the next thing we have on the balance sheet is we have our liabilities. All right, now we only have one liability, and that liability is, think about it, yep, it's accounts payable, right? So we see it here. We had a few things happen with accounts payable, so let's add those up. So first, we had $3,000 of accounts payable from the furniture store. Okay. All right, then let's see. Oh, over here with the utility bill that we didn't pay, we had more debt, more accounts payable of $350. So we're going to add that, more debt. But then toward the end of the month, remember, we paid $1,100 to the furniture store. So we decreased our debt, decreased our accounts payable by $1,100. So when we add all that up, our accounts payable are now $2,250. So that's what we're going to have here for accounts payable. Down here, liabilities. And since that's our only liability for this question, we can add up and get total liabilities. All right, one last section for our balance sheet, and that is equity. All right, and let's, somehow I just can't make that even. I tried. Okay. Unfortunately, in these lectures, you are going to notice a little bit of a technological issue. Doing my best. Okay, so what's in equity? All right, so equity is going to have two things in there, two accounts. One of them is right here at the beginning, common stock, right? We have $8,000 of common stock. That's going to be part of equity. So let's put that in. Now, there's one other account in equity, and it is retained earnings. How much is retained earnings? Well, we know because we already completed the statement of retained earnings. So this is generally why I recommend doing the balance sheet last, because otherwise you get to retained earnings and you haven't updated it and you've got to go back and do this anyway. So we're going to use this $150 for retained earnings, right? The part that's at the end of the statement, what they have at May 31st, which is of course the date of the balance sheet. So we're going to have $150 of retained earnings. Okay, Now, when we add that together, we're going to get total equity, which is $8,150. Now, it looks like we're done with the balance sheet, right? We have assets, we have liabilities, we have equity, but there's one more thing we need to do. We need to add together liabilities and equity. Okay, so let's add those two things together. Liabilities and equity together. $2,250 of liabilities plus $8,150 of equity is $10,400 of liabilities and equity. All right, why am I adding liabilities and equity together? Because that's my balance sheet equation. What I'm showing is that assets equals liabilities plus equity, right? So the two amounts are the same. That's showing that my balance sheet and my balance sheet equation works. All right. Okay, one last thing, and I didn't address this, but I'm sure a couple of people were asking it. Back when I was doing this, and I said, oh, our second account here in equity is retained earnings, I think some people might have been thinking, wait, isn't that dividends? Shouldn't dividends be the other account in equity? Well, dividends does impact equity, but it impacts equity through retained earnings. The dividends are listed right here on the statement of retained earnings. So that $150 of retained earnings that I showed already includes the $100 of dividends. So I'm not going to put dividends again down here in equity, because if I did, it would be double counting it, and then the numbers wouldn't add up and I wouldn't get the balance sheet equation working out. So I can't include dividends here because they're already part of retained earnings. So they're not shown separately. The only place dividends are shown separately is here on the statement of retained earnings. Okay, so we've practiced some transactions, right? I've gone through how to bring those and make financial statements. What we're going to do next lecture is we are going to apply all these transactions and journal entries into T accounts and show how we can more easily accumulate the numbers, right? So that's where we're going next class. So the homework, and this is due on Tuesday. From last time, I assigned questions 4 and 5, and now I'm going to assign questions 6, 7, and 8. So more practice on journal entries and putting financial statements together. And then I will be here next lecture. Until then, have a good day.